So Yali, there are lots of yes and no's coming up. Oh my
Mm-hmm.
God.
I
I can see
expected
many
that.
of them saying no. I think
Okay.
we would want to have multiple credit cards then. Sally, what say? Personal with
Multiple
multiple credit
credit cards.
cards.
Yeah. I'm glad that whoever answered no was really honest with their answers. I mean, I'm very
Yeah,
happy. Thank you for being so honest. It's okay. I mean, even if you answer yes, even if you answer no, everybody is going to take something from this webinar. So let us see whoever is answering. No, I don't monitor my expenses. Yeah. Uh, Someone is
yes.
saying yes. Most of the times they do. Okay. I don't track
But
my
I can
expenses.
see
I
most of
may do
no's,
that.
Sally.
No's.
There are a lot of
Okay.
no's,
I think most of the people they want to, but they are not
but
very
they are not
sure
doing.
because like
That's true.
first week of every month it's like it goes in a jiffy. So I think yes, everybody wants to find out what are the preferred ways, what is a methodical approach to do that. So thank you very much for participating. You are more than welcome to keep on answering the same question. I think we will start with our webinar today, which is again packed with a lot of information and insights. And at the end of the webinar, I'm sure if I ask the same question to all of you, everybody is going to say, yes, I will be monitoring my
Tracking
expenses.
my
If you are
expenses.
an individual, if you are an entrepreneur, if you are in some position in your company, everybody is going to answer yes. Okay.
Yeah.
So over to you, Ankita.
Yes, sure, Sally.
Thank you.
Sally, so amidst all the no's, I think we have, I mean, a lot of audience saying no to recording their expenses, but I think that is inevitable. I think that is very important because when it comes to recording your expenses and your income, there is always a balance happening, always a balance which again, puts you in a pressure all of the time. So we'll see how it goes. And when it comes to business, it's very tough. So, friends, we'll just look at the agenda that we have today. So, today's comprehensive guide for bookkeeping takes us to the introduction in bookkeeping. We'll be delving into the essential aspects of managing our financial records, demystifying the world of numbers and transactions. Going ahead on number two, we have the accountancy and accounting systems. Yes, indeed, bookkeeping is way different from accountancy. It's not the same. How different it is, we'll have a look. And then going ahead, we have to look at what double entry bookkeeping is. Every time these entries are such a mess, such a problem. We don't know what to debit, what to credit. So I think we'll have a look at that as well. You'll also gain a good insight into the distinctive roles of bookkeeping and accounting. Once we set the stage for a deeper exploration in financial management, we take a center stage where we record the transactions. We have the journal recording, the ledger, the final accounts. Okay. So that is what we are going to do ahead. We are going to see how journal and ledger are very important in bookkeeping. Going ahead, we have the subsidiary books. Also, after journal ledger, we are not sorted. We need to know everything in accounting. We need to know everything in bookkeeping. So subsidiary books also help us get a small brief, a quick brief on what we want. We want cash balances. We want the asset liability balances. We want the income expense balances. Okay, so we'll have a look at the subsidiary books. Then comes the bank reconciliation statement. That's a mess because when we have to manage our cash and bank balances and also compare them, I think that gets something very tough, and we'll see how we reconcile it. And lastly, we'll have, everything and anything has got errors. So how we fix errors and correct errors in bookkeeping. So I think that is what will be our agenda for today. And I want you all to enjoy and have a good time. If you have any questions also, do let us know in the chat box. We'll be having a Q&A session at the end where we'll try to answer majority of your questions. Okay. So Sally, the next slide, please. Okay, going ahead. The next slide says, what is bookkeeping? Okay, now bookkeeping, we'll just look at the definition first. Bookkeeping means the recording of the business transactions in the books of accounts in a systematic manner. Now, again, systematic manner is a very tricky word here because systematic means recording it on a daily basis. Okay, if not daily, when it occurs, if not that monthly, and in a proper format as set by the rules and regulations in bookkeeping. So you just can't record any transaction out of the blue stating, I got money from a vendor, I paid money to someone. Okay. So I think this is very important when it comes to bookkeeping. So all these activities are recorded for the purpose of taking important decisions in business finance. We have to generate reports. We have to have some analysis in our business. We have to check if our business is feasible or profitable. So this is what we do every day, and this is how we have to record the bookkeeping. Now, all of us had a lot of time doing all the bookkeeping transactions, recording debit and credit, but do we all are even aware when it all started? Okay, so let me take you back in history, sometime back in 1494. Yeah, it's a long time, but yeah, so the credit goes to Luca di Barco Pacioli. Okay, so he was an Italian merchant and he was the person who had established the method of double entry bookkeeping. He was the one who brought it to the world. And during the 18th and 19th century, somewhere around the Industrial Revolution, we all must have studied it in the history, right? We all know the 18th and 19th century was a phase where there was a lot of setup of industries happening, the joint stock companies being set up. And around that time, there was a need where the business owners thought there should be separation of ownership and management. Now, when I say there is separation of ownership and management, I mean every time I own a business, I have to manage it. But every time I'm managing, I need not be the owner of the business. So I can hire people who manage my business, right? So this is what the ownership of business and separation of management happened. There was a time when there was a need of bookkeeping, and this set the stone. This set the stone for bookkeeping. This set the stone for accountancy. As and when it started evolved around 20th century, we all know what mandatory disclosures are. Now, mandatory disclosures, again, when I say mandatory disclosures, I mean that there is something which has to be compulsorily presented to the general public. Okay, it has to be mandatory. And mandatory disclosures help me realize how my business is going. It also helps people realize how the business is doing because, after all, general public is the people who invest in a business. So that is why it also has become a very important aspect of business these days, and it also differs in many ways. So it has also become a social responsibility in the 21st century. So I have to manage my business likewise. Okay, so let's see what bookkeeping looks like. We'll look at the features of bookkeeping all in all. Okay, thank you, Saili, for changing the slide. Going ahead, we will see the features. So basically, what is bookkeeping? Bookkeeping records a transaction for a specific period of time, a month or a year. Yeah, this is very important because I have to record every transaction in my business at a particular date for that particular month and in that particular year. Because every time anything I do should be for a complete financial year, starting from 1st April to 31st March, or from the financial year that you follow, okay, or the business follows. Now, the second important feature of bookkeeping is recording as per rules and regulations. I have to record all the transactions as per the stated rules and regulations, the accounting standards I follow, the set format of journal, ledger, and recording the transactions. So it has to be at a particular date as per the rules and regulations. Now let's see the third important feature, which is date-wise and account-wise recording. Very important because date-wise recording is important. There will be huge volumes of transactions. Let's say for a particular month, I have been getting lots and lots of orders in my business. And if I have to record the same, where do I go? So it is better that I record my transactions on a date-wise and an account basis. So if it's a sale, if it's a purchase, it's an expense, or it's a income. Now, what is the purpose? The purpose of accounting these transactions is to know the assets and liabilities, is to know my profit and loss. Again, these are very heavy words, the assets, liabilities, profit and loss. We'll have a look at them once we go through the accounting terminology. Now, going ahead, it's an evidence of trade. Yes, indeed, it's an evidence of trade because as these days we are conducting trades, huge volumes of trade in particular in the domestic country and internationally, anytime a third party issue occurs, what am I going to do? When am I going to answer? How am I going to answer the third party if there is a legal suit happening? Okay, so I think that is an evidence of trade. I can present it at any time and I'll be absolved of the responsibility. And lastly, I have it allows growth comparisons. Yes, indeed, because nowadays every business has to at least for 10 years of time have their accounting records being kept for yearly growth comparisons. just to understand and know how the business is flourishing and growing. So I think this is very important feature in bookkeeping, and these features are very unique to bookkeeping. They are intact and have been intact for quite a long time. From when they have evolved, there has been a lot of change happening. So we'll see what kind of transactions come up now, and we'll see how we record them. So Saili, can you
Ankita,
please?
I have a question here.
Okay, yes,
So
Saili.
if I go to my regular grocery store and I buy my weekly groceries, and while doing the payment, I use my debit card and not the credit card. So
Mm-hmm.
will you help me with the what kind of transaction would it be?
Exactly. I'll help you with that. So basically,
Okay.
slightly once we go to the next slide, I think I'll be able to help you with that as
Thank
well.
you. Thank you.
Sally, can you please? Okay, thank you so much. So, as we can see, this particular slide says that transactions. Now, as Siley has rightly put up and said that she went to a grocery store, she got something by paying with a debit card. Okay, so that was her debit transaction. That is what she paid. She paid it through bank. It was either a cash transaction or a bank transaction, right? So basically, what is a transaction? A transaction is an exchange of money or money's worth directly or indirectly. I think we all like the second option more, Siley. Am I correct?
Yes, absolutely.
Yeah, so I think we all are fond of the second word, which is credit. So every time we want to have a transaction, buy something in the market, I think we go for the credit one. But yeah, I think a business plays a very important role in deciding which kind of transaction they should be choosing and vice versa. Okay, so basically, we have two important kinds of transactions that a business conducts. Okay, so cash transactions involve the immediate exchange of currency, coins, or digital equivalents for goods or services. Now, in this scenario, payment is instantaneous because it's easier and everybody relies on it. And businesses often prefer cash transactions for the simplicity and speed. It's easy, it's fast, it's instantaneous, and it's anytime you are provided you have that much of cash. But then you also transact in cash. So always, every time a business won't go with cash, but it is easy and speedy. So now basically cash has got a very, very unique feature, which is its tangible nature. So the tangible nature of cash makes it universally accepted medium of exchange, and it reduces the risk of disputes and delays later on. So I think this is very important when it comes to on purely cash transactions. So business may deal in only cash transactions and record the transactions only in cash. Now, going ahead, we'll have a look at the credit transaction. Now, this is a contrast here. There is a huge contrast here. Now, you might be wondering why would a business always go for only credit or only cash? So there is always a mix, let me tell you. All businesses go with a mix of transactions, okay? So now in contrast, credit transactions involves the extension of credit. Extension of credit means every time I have to have every time a transaction has occurred, I don't make the payment immediately. I make it at a later date. I make the payment afterwards, or I make it in the appearing month or the coming month. Okay. So now credit transactions involve the extension of credit, allowing customers to purchase goods or services with a commitment to pay later, which is true. So let's suppose you go out in a grocery store and you pay with your credit card, which means the credit card is just a facility provided by the credit card provider or the beneficiary to you. Okay, so it is being provided to you on behalf of making payments. They make payment on your behalf, and then you later on pay the credit card bills that you do. So basically, this deferred payment arrangement is has got its own complexity, but then it is preferred by businesses because it helps in stimulate business growth, and alternatively, it also helps in uh, having a feeling or developing a feeling of loyalty, a reputation. It builds a reputation for your business. So, however, introducing a credit risk in a business is at times has to be very proper, has to be appropriate, because effective credit management system involves setting some credit limits to your business. So every time I have to set up a credit limit in my business, I have to decide the volume of transaction I would be conducting in credit or would be having in credit. And also I'll have to monitor the payment behaviors because I'll have a lot of vendors. I'll also be a vendor to somebody someday. So basically they would be monitoring me and I would be monitoring them in return. So basically there is a cycle. There is a continuous cycle happening. So let's suppose I have a transaction, and once that transaction is conducted, what happens is I have to ensure that the transaction goes on smooth, the transaction goes well. Okay, so this is how is the payment behavior. So this happens in continuous cycle. This continuously keeps happening. So every time my debtor has to pay me, the person pays me after 10 to 15 days. And then there is another set of cycle, then the cycle. So this goes on. So this is how my payment cycles will be.
So mine was definitely not a credit transaction.
Exactly.
Okay.
Okay, now this slide introduces us to the facility of accountancy or accounting. So now basically accountancy, what is it? So accountancy is the practice of recording, classifying or reporting of business transactions for a particular business. Yes, indeed, because accountancy is way different from bookkeeping. What is bookkeeping? Bookkeeping is the art of recording the business transactions, where accountancy helps me make some analysis, make some changes, make some generate some reports for my business, also track them, track my budgets, and track the finances in my business. Okay, so that is how I record my transaction. That is how bookkeeping is different from accountancy. Now we'll also have a look at the accounting cycle. Okay, so the accounting cycle is something where I record my transaction journal entries for the first time. Then I post the journal entries to my ledger accounts with the available balances. And then I transfer the balances of my ledger to the trial balance. And from trial balance, I generate the trading profit loss account and balance sheets. So this is how our accounting cycle will be. We will also have and understand how this goes on. Okay. So going ahead. Yes, this has been very important and inevitable because I think there are two different set of accounting standards that are followed worldwide. Okay, so the first is IFRS and the second one is GAAP. So we'll see what IFRS and GAAP are. So IFRS is a set of accounting standards developed by the International Accounting Standards Board, which is IASB. It's an independent private sector body based in London, and IFRS is widely adopted around the world, with many countries requiring or allowing its use for financial reporting. Also, its key features of IFRS includes it's more of a principle-based approach. It uses principles that are set forth by IFRS and provide broad guidelines that allow for interpretation and emphasis of fair value treatment for certain assets and liabilities. Okay, so it's fair value measurement of assets and liabilities. And also IFRS focuses on the economic substance, okay, of transactions. So that are generally more flexible in application. It's more flexible compared to GAAP. Now, GAAP is a set of accounting principles and standards, procedures set by, again, FASB for companies in the United States itself. So it's applicable in only United States. And GAAP has been the predominant framework for US financial reporting for many years. Okay, so this is how IFRS and GAAP differ.
Ankita, I have a question again. So
Yes.
if I'm working in a company and my company's headquarter is located in the United States and they have a branch office in South Africa, so what would be the standard procedure, or rather which standard should they implement?
So basically, Sayali, as you said, your company operates from US. So I think because they would be have the operations part being controlled, the head office being in US. So I think more likely the company is, set to or will about to follow the US GAAP. Other than that, if it is feasible for the company to follow the particular region specific norms, that also can be done.
Okay, great. That was very helpful information.
Okay. Was there a poll shot, Sally? There was a poll being shot.
Yeah, we will do it in a while.
Okay, thank you, Sally. Now going ahead, I think this is the basis of accounting system. Now we will come to the cash and accrual basis of accounting. So basically we'll see what are the three major bases of accounting system. Okay, so we have the three major bases being first the cash basis. Okay, so all cash receipts and cash payments are recorded in only cash. So every time my business is set up and my business has got a set of rules, okay? Let's suppose I have to follow a cash basis. So my business has set it up. Okay, so I follow the cash basis accounting. Okay, any income or expenses made in cash. Now, the second one is the accrual basis. Okay, now accrual means something that keeps accruing over a period of time, is not immediately paid, is credit in nature, and also has to be recorded in the books at that date. It may accrue later on, it may be paid later on, but the record happens on the day itself. On the day it is record, on the day it happens, on the day it is being transacted. So revenue, whether received or not, has been earned or not, or accrued during an accounting period, and expenses incurred whether paid or not are recorded. So any income or expense, receivable or payable, okay, is done only on an accrual basis. And the third basis is a hybrid basis. Now, what's a hybrid basis? It's a basis which is a mix of cash and accrual. So I record my transactions also in cash, and I record my transactions also in a accrual basis. Okay, because at times it happens in business. I'm never sure when my debtor is going to pay me. Even I'm not sure when I'm going to pay to someone. Okay, because all the time you don't have that much of liquidity with you. You don't have that much of cash with you, cash holdings with you, or even if you have, you don't want to convert it into cash easily. Okay, so every time, again, I'll say, when it comes to liquidity, more the liquidity, great the business. Less the liquidity, less great is your business. Okay, so liquidity is something which is very important. So it's a combination of cash basis and accrual basis.
Ankita, can an organization go for a hybrid system on a regular basis?
Yes, Ayali, normally it happens that businesses not don't follow just one system, only cash or only accrual. It is always, all the businesses have a mix of hybrid basis. And when you have good receivable, okay, when you have better debtor collection period, creditor period, so you always have this feature where you have to go for hybrid basis.
Okay, thank you.
Okay, now we'll have a look at the accounting terminology. Now, this accounting terminology is very unique. We have simplified it for you. We have made it very easy so that we understand what we are going to do ahead. So what is a capital? So capital in a business is the total amount invested into the business by the proprietor. Yeah. So I'm the business owner. I have to start up a business. Okay. I'm going to require an X amount. Okay. And what does my capital include? What does it look like? So my capital is equal to, this is the standard formula for capital. So my capital is equal to assets minus liabilities. So assets is everything that I hold in cash and cash convertibles. Okay. Something that can be easily converted into cash, something that is easily liquidable, that which I can easily liquidate. But liabilities is something that is payable. Okay. I have to pay it at a point of time. I have borrowed some money from somebody. Let's suppose I have borrowed some capital from my family and friends. I don't have that much of capital and I have to borrow it from family and friends. Later on, after a while, I would have to pay it back to them. That is my liability. That is my payability. That is where I will be paying. So my assets, something that I hold, minus my liabilities, becomes my capital, which can be invested and reinvested into the business continuously. So this is what is my capital in a business. Drawings. Now, drawings is a very peculiar feature. Okay, why is drawings? Because I draw something out of the capital. I bring out something from the capital. And when I draw something from the capital, I mean, I use it for my personal expenses. I use it for the personal use. I make use of these things for my personal reasons. Okay. So the amount of cash or value of goods withdrawn from business for personal use is called my drawings. Going ahead.
Ankita, will go with the first question.
Okay, we have the first poll.
Yeah. What is the primary purpose of a balance sheet? Let us see what people answer. Please click on the right option. There have been you have been given options. Please click on the option which you feel correct. We will discuss this question later. Let us have maximum participation.
Sally, this is a very, very interesting question. Which of the following represents an expense in accounting?
Yeah,
We'll
it's
we'll
an
also see,
interesting
we'll have
question.
a look at the answers, Sally.
Yes. I hope all of you have participated in the poll and clicked on the correct option you feel. Let us have the poll answers. Let us see who has clicked on which option. Sanjita, can we have the poll statistics?
Sure. Do you want me to run for another few
Yes,
seconds?
yes, Sanjita. Let
Okay.
the
Okay, I'm ending the poll, so you'll have the poll result.
Let us see who have clicked.
Yeah.
Okay,
Which
Ankita.
of the following represents an expense? Yes, it is an expense. Yes, because rent is being paid and it's also one of my expenditures, which is not capital in nature. It's my revenue expenditure. Rent is something which I keep paying all of the time. Every month it comes up to me and I have to make the rent payment. So I think that is my expense.
Absolutely, yes. So basically, whoever is paying the rent, you have to consider this point and make sure that you have the right information about it. Let us go ahead on the next slide. I may have a couple of questions for you, Ankita.
Oh, sure. Thank you, Sally. So I think the second most important is the debtor and creditor. Oh my God, these are two problematic people. So basically, we'll look at what a debtor is. Now, debtor is the entity who owes money. Okay, an XYZ person I buy, is a vendor. Okay, and the person who owes me money. Okay, today this person would pay me or may not pay me. Okay, so that could be my person. So person who owes me money in a business is my debtor. But a creditor in return is the person who I owe money to. Okay, might be any other person, might be any person I get my raw material from, might be any other person I get my machinery from, or any other person who I buy my regular, things for office from. Okay, could be any other person. So creditor is the person who I owe money to. Okay, but I think Sayali, there is a very important thing in this particular slide as well. So can you just let me know what it is?
I'm looking at something called bad debts. Is that right?
Yes, that is correct. I think bad debt, something that went bad. Okay. So basically, at a point in business, wherever over the year it happens that any of my debtors, somebody who owes me money, doesn't pay me back. Okay. And over after repeated reminders, they don't pay me. I also have huge amounts being owed to them and they don't pay me. I call it as bad debt, something that went bad, something that was not paid back to me. So that is what is bad debts.
I think you already answered my question because looking at the slide, I remember that a person owes me some money, and I was about to ask you, what if he doesn't return that money to me? So I think it goes in the bad debts. I mean, you have already
Yes,
answered my
it
question.
goes in the bad debts, and a business might have a huge amount of bad debts at a particular point if they are not able to set their debtor cycle very well. Okay, so that is their collection period, that is their average collection period. That is what I was talking when I was talking about the cash and credit transaction. So my business has to set my average collection period so well that I know every 15 days I'm going to receive money, and that is the very beautiful art of the accrual system or the credit system that I follow in a business. So my debtors have to be, I also need to know my average collection period. So let's say my debtors are paying me back after 20 days. So almost 80% of my debtors pay me back after 20 days, which means I've got a very good average collection period, okay, which is a debtor collection period.
Okay. Let us move to the next slide.
Going ahead, now we'll also have a look at the expenditure. The expenditures, please. Thank you so much. So we'll have a look at the types of expenditure. Okay. We have very interesting questions, Sally. Let me tell you, we have very interesting questions coming up from learners in the chat box. We will also make sure we answer them at the end of the session once we are
Yes,
done
yes,
with
we
the
will
live.
make sure that we answer all the questions.
Yeah. So going ahead, we'll have a look at the types of expenditure or business incurs. So we have a capital expenditure. So what is a capital expenditure? Basically an expenditure which is incurred for gaining, for acquiring an asset. Now asset is something which I can use over a longer period of time. I don't have to keep buying it again and again. I buy it once, I make this one-time payment and I'm sorted. So this is my capital expenditure. What is the example of capital expenditure? It's either a purchase of machinery, or extending a building, okay, or purchasing of computers or a set of computers, purchasing tables or chairs for my company or for my office. So this is my capital expenditure. Now, second kind of expenditure that comes is the revenue expenditure. So the expenditure which I continuously keep incurring over a period of time, something that continuously keeps coming up. I have my stationary expenses, I have my salaries to pay, I have my wages to pay. So every time this keeps on coming, it accumulates over time, it recurs over time. So that is my revenue expenditure. So I pay rent, I pay salary, okay. Going ahead, we have the deferred revenue expenditure. Now, deferred revenue expenditure is an expenditure which is spread over number of years. Okay, so basically, at times there is a legal suit happening. Let's suppose there is a legal suit my company is fighting. Okay, and there are these legal suits which require continuous updation in terms of revenue expenditure, in terms of expense that I make towards them. So that is what I expense on the legal suit. I expense on advertising. Okay, so every 1 year, every 2 years, or every 3 years, I need to change my strategic advertising. I need to make it more better. I need to make it more convincing to the audience. So this is what is my deferred revenue expenditure. We go ahead, please. Okay, now again, very important thing in accountancy is the assets. Okay, so we have, what are assets? So basically there are three different kinds of assets. So we have fixed assets, we have current assets, and we have fictitious assets. Now fixed assets are the assets which give a long-term benefit in my business. Now long-term benefit, once I purchase them, I don't have to purchase them again and again. They are fixed in my business and they are valued the highest. They are on a very high value. Okay, so I buy multiple assets. I might be having multiple buildings. I might be having multiple machinery. So I have the land and building, plant and machinery, and goodwill. Goodwill, again, Siley, let me tell you, is a very, very important fixed asset for me, because once I build my goodwill, once I build my business reputation, I think it goes on for a longer period of time. What do you say?
So goodwill is the image that people have in their mind about the
Yes,
organization.
yes, indeed.
Okay,
Yes, indeed.
okay.
Because when I set up a business and I have a set, reputation of my business, so this goes on for a longer period of time. Do you guys, I think our audience might agree to what I say. Let's suppose you have a favorite brand of yours and you go back to the brand again. You always go and buy the same thing, right, Sally? So you go back to the same brands again and again. So where does that come from? Let's take an example of Starbucks. Why do you love Starbucks coffee so much? You love it because it has built a reputation. It has built a brand image in itself. So I think that stands as a very important fixed assets in my books of accounts. Now going ahead, I have the current assets. Okay, so the current assets are assets held for operations of cash convertibles. So every time my assets are in current, I can easily convert them into cash. Are in my operations, are the ones which I am employing. Okay, are the ones which I employ in my business. So my debtors, my bills receivable, my cash in hand, my cash at bank, which again, are can be easily converted into cash. So that gives me the highest liquidity. If I have good amount of current assets with me, which means I'm having a greater liquidity in my business. Now, fictitious assets, coming to the ones, assets that are not represented by any tangible possession. So I don't hold them, but they prove as an asset. That's what I discussed some time ago. So deferred expense like advertisement paid for 4 years. So basically, when I pay for advertisement for 4 years, I'm assured, okay, because I know this is going to work in my favor. It's going to work for the rest 4 years that I am employing my resources on.
This
So
is a
this
very important piece of information, Ankita, because I always thought assets are assets. But I mean, goodwill is something that you cannot touch, you cannot feel. It is something an abstract, but still holds a very, very important position in the company's overall standing or image. So I think that this slide is very, very important. Okay, let us move to the next slide.
now this is a very tricky person. This is a very tricky thing in our business, because liabilities, every business is not very good in this. Let me tell you, audience, you have to be very, very, very attentive in knowing your liabilities in a business. So we'll see what kinds of liabilities we have. We have fixed liabilities that have to be paid over long term. Let's suppose I've got something for my business and it is to be paid at a later date. So amount payable in long term. Something I have given you an example some time back where I say capital is to be repaid back. I borrow from someone. At some point of time, I'll have to pay it back. So capital, secured loans, and long-term loans from banks are the ones which I pay back. So these are my long-term liabilities. Current liabilities are the ones which I have to pay now, have to be paid in a shorter while, will be paid in few months of time. Okay, so short-term liabilities are payable within a year. Okay, let's suppose I have to, I owe some amount of X amount of money to someone. So at a point in time, I say that I'll be paying it this year. I'll be paying it in this month. Okay. So this is my short-term liability. And it will be a shorter in figure. It will be less than figure. Now, going ahead, we have net worth, owner's equity, or capital. So, Ali, let me tell you, these three things are same. Okay, so net worth is equal to the owner's equity and also the capital. It's the amount of funds provided in a business. Okay, so that is something which is provided by a owner in the business, and it has to be paid back later. So, with the
Then
formula
why
for
is it called equity? Why is it not called capital?
it depends on the business. Okay, now why equity is because there is a lot of borrowing happening in terms of shares in a business. So that is my equity capital. Okay, so I always call it as equity capital instead of calling it only capital. Okay, so net worth, so we'll see a formula of capital. So net worth is equal to the owner's equity, which is also equal to my capital. Okay, so it's all in all one thing. Or the formula is the owner's equity is equal to total equity minus creditors. So assets minus liabilities. Going ahead, Siley. Okay. Now this is a very interesting feature. Here we start with a double entry bookkeeping system. We'll have a look at the two important systems in bookkeeping, Sayali. Sayali, have you ever heard of a single entry bookkeeping?
Yes, somewhere back in college, I heard about the single entry bookkeeping.
And how much of double entry bookkeeping have you done in college?
I remember something called as debit and credit.
Oh,
Uh,
okay.
Very vivid memory.
Yeah, so I think we'll have a look at what single entry bookkeeping is. I think very few of us know what single entry bookkeeping is. So let me tell you, single entry bookkeeping is where I pass a single entry, only one entry, or I record it only once in my books of accounts. It does not involve two accounts in it. Okay, so every time I have a transaction happening in my business, it will be recorded only once. Whereas the double entry bookkeeping is where I have to have two accounts. There are two accounts involved in double entry bookkeeping. Now, convenience wise, I think single entry is very easy and convenient. There is no need to get trained or have training in recording single entry. It's only dependent on estimation, but it doesn't come from reliable source. So let's suppose I have a transaction today happening. Let's say I sold something worth $5,000. So I record it. Tomorrow I purchase something worth $2,000. I record it. I pay rent for $3,000. I record it. So this is how I record my single entries. Okay. Single entry is basically not followed by much of entities. Okay. It's very rarely followed by very, very small businesses where they don't need disclosures as such. Okay, whereas double entry bookkeeping is not convenient. It is a process where it involves a whole lot of record keeping happening. It requires formal training. Yes, indeed, you need to train yourself in bookkeeping and then accordingly go for it. It has to be highly accurate. It's highly accurate. It's reliable. It gives you an instantaneous information, and it is regulated. Yes, it is regulated because you have to do it as per the rules and regulations. Okay, going ahead, Sayali.
Let us have a poll question.
Yes, sure, we can have a poll.
Launching the poll. Oh, this is also an interesting question. What does the term cash flow refer to in bookkeeping? Now, I'm sure that people will click on the right answer. There are three options being given to you. The money coming into and going out of the business, is it called the cash flow? is total revenue of the company called as cash flow, or the profit earned in the financial year is called a cash flow? I request all of you to participate in this poll so that we have good participation and maximum people should think about what cash flow means.
Audience, I'll give you a hint on it. Sayali, am
Okay.
I allowed to give you a hint?
Yes, please. I'm
Yes.
sure that the attendees will be very
So
happy with
huge
this.
incoming and outgoing of cash, I think, in my business, if I'm not wrong.
Okay. Last 10 seconds. Kindly click on the correct answer you feel. What does the term cash flow refer to in bookkeeping? Okay, we'll be closing down the polls. And let us have the poll statistics.
Yes,
Oh,
correct. I
amazing.
think 95% goes for the incoming and outflow. Okay, so we have this 95% where we see the cash flow, where we have the incoming and outgoing of cash happening. That is the flow of business. Okay. Thank you, David. I'm grateful that you enjoy my lecture. Going ahead, Sayali.
Yes.
Okay, very well. This is a very interesting segment here, Sayali, because we will be having a look at the single entry balances. Okay, so we'll have a look where a person has recorded his transaction starting from 1st of June, and the ending balance for the week was on 7th of June. Okay, so the first transaction that we look at is the starting balance of the week. So he started the week with $5,000 being the starting balance. Okay. And then the next day, there was a transaction where he paid for rent. So it was his expense, as you can see that it was an expense of 1,000. Okay. So $1,000, he made a payment of rent, and out of 5,000, I subtract 1,000, it gives me $4,000. So he is on balance of $4,000 on 2nd of June. Going ahead on 3rd of June, there was an invoice paid Excel Technologies. So, okay, so there were Excel Technologies who were to pay me $500 on 3rd of June, and they happened to pay me, that was my income for 500. So with 4,000 and 500, okay, I come to 4,500 on 3rd of June. Then I have the next transaction being conducted on 4th of June, where I got some supplies in my business with respect to furniture. So I got a furniture. Why is there a note here? Because basically, what did I expense for? I should be quoting it down. I should be writing it down. That is why there is furniture coming in. So furniture came in my business worth 1,500. So I had my balance on that particular date where it was 4,500, and then I subtracted 1,500, I expensed towards furniture, my balance came down to $3,000. And at the end of the week on 7th of June, my ending balance came out to be $3,000. So Sayali, am I pretty clear on this?
Yeah, I was wondering that why am I seeing just one entry into every column? But then I realized that it has been categorized into the kind of expense it is.
Yes,
Am I
yes.
right? Yeah.
Yes, Sayali. And as this pertains to a single entry in bookkeeping, so there is, as I told you some time ago, that every transaction is recorded only for one time, only for single time. Okay. There is no two accounts being involved. As and when a transaction occurs, I record it and I'm sorted. So that is how I manage my balance. I start with a balance. I keep deducting if it's an expense. I keep adding if it's a income. So this is what is easy in terms of single entry bookkeeping. Okay, great. Now coming down to classification of accounts. Now, how do I classify my business payments or business receivables or incomes in different accounts? So I have two sets here. Now I have two sets of accounts that I classify my transactions in. So I have personal account, which is a natural account, which is a person's account, could be a John's account or Shelley's account in person. Okay. Now, if it's an artificial person is not an actual person, is not a person who actually is holding an account, but could be a trader account, could be a hospital account, could be a municipal corporation account. So could be Max Traders or the city hospital account. Now coming to the third type in personal accounts is the representative account, something that represents it. So let's suppose I have a rent, okay, outstanding, which I am yet to pay, or a prepaid expense that I already have paid. Let's suppose I have paid a salary in advance. So that is the prepaid salary that I have paid to an XYZ person. So I record it in my books. Okay, so who I pay to and who pays me. Okay, so that is representative of it. Now, the second most important classification is the impersonal account, something that do not belong to a person, but still have to be recorded in a business. So those are real accounts. Okay, so those are tangible real accounts. So tangible, something which can be touched, something which is already there, which is fixed for a period of time, could be computers or cash. Intangible real are the goodwill or the copyrights. So every time intangible real and intangible real account is a very simple account. Okay, so goodwill is accumulated over a period of time. It is calculated later on. At the end, it is revalued. Okay, so this happens after longer periods of time. I record this after longer periods of time. Whereas nominal account is somewhere where I record my expenses and losses and incomes and gains. So all my everyday expenses, whatever I pay, irrespective of my stationery, my advertisement, the wages that I pay, okay, the rent that I pay are all my expenses, something that I expense on a daily basis every time. Whereas incomes and gains are something that I receive. Could be the interest which I have received, could be the discount which I have received, could be the commission which I have received. So I think we classify these accounts under various heads in accounting. Okay, and this is where this is how I record my transactions under all these heads. Okay, we'll see ahead how.
So, Ankita, if I receive some dividend on my shares, will it go under the income and gains category?
Yes. So Sayali, what happens is if you received it on dividend depends on how often you are getting it. Okay, so if you are getting it, so your dividend is again on your capital. Okay, so it is received on capital. So that is why you will record it likewise.
Okay.
Okay, this is very interesting. We all know what this is, and we all are very aware about the peculiar golden rule in accounting, which is the golden rule of debit and credit with respect to different accounts. So now personal account is debit the receiver. You have to debit the person, okay, or from whom you have received, and credit the giver, the one who gives you the credit. For real account, the rule is different. Debit what comes in, you have to debit what comes in into your business, and credit what goes out of your business. For real account, it is specific. For nominal accounts, debit all expenses and losses. I'll debit all expenses, something that I expense at any time. Let's suppose I buy stationery worth $50, I debit. And let's suppose credit all incomes and gains. Okay, if I get some money in my business, I receive something, it will be credit all incomes and gains. Also, audience, I want you to know that every debit has got a subsequent credit. It has to be, because it's the double entry bookkeeping. It has to have second effect. Every time you will have a double entry bookkeeping, every subsequent entry will have a double entry. So anything will have a cross entry to it. Everything will have a cross effect to it. Okay. So going ahead, Sally.
Ankita, I'm still a little confused. I think can we have an example on this so that this becomes even more clearer?
Okay, okay. So I think, Sayali, the next example, the next set of examples will be very, very helpful in letting us know and understand what it is like. Okay. So let's say Sayali, can you just read the example for me, please?
Yeah, sure. So there's a company called XYZ and it purchases equipment for $3,500. This would result in an increase in equipment since the company gained an asset and a decrease in cash since the company paid. Since both equipment and cash are assets based on the table above, equipment is debited for $3,500 while cash is credited for $3,500 saved. So you would record the journal entry like this. So on December 8th, equipment is $3,500 and to cash the same amount, $3,500. So can you explain this, Ankita?
Yes, sure. So, Sally, I think this is a very easy example where we are looking at what debit and credit looks like. Okay. How do I decide debit and credit first and first? Okay. So the first thing is I purchased equipment for $3,500 and my purchase was for cash. Okay. So what came in into my business? Sayali, I think the equipment came in, right?
Equipment,
Yeah.
correct.
And the equipment came in into my business. I got an asset for myself. Okay. So I got an asset. Fine. Now this will debit what comes in. What came in into my business? Equipment came into my business. What went out of my business? Cash went out of my business. I paid it in cash. So that is why cash went out and equipment came in into my business. So that is why I record it as equipment account debit to cash. Okay. So wherever in places you may find the entry is just equipment and cash 3,500. It is also correct. To cash is also correct because at times a few accounting systems follow two in front of the credit account. So that is why to record the purchase. Sayali, can you see something in bracket under it? Yeah. So that is
Yes.
something. Yeah. So that is something which is a small description on what I have done, and it's good always. You know, when you record a transaction, it's good to describe it on what what I have conducted, what I have done here. So it's giving me a small glimpse that I have recorded a purchase of equipment here. It's not a purchase. It's different from a purchase because purchases would be regular. Equipment would be only one time. Okay, Sayali, going ahead.
I think in order to help our attendees even better, I have a small example of a person called John, and he has this small bakery which he has recently opened, and he started this bakery with a capital of $50,000, and he has incurred several expenses, maybe buying some his equipments for baking, maybe the materials that is required for baking. So let us see. I think this will be very helpful, Ankita, for the attendees in order to look at each and every transaction, how John is going through. Shall we do that?
Yes, Sayali, we can. So I think Sayali, you should go with the first transaction. You can read the first transaction, then I'll explain you the two effects.
So the first transaction which is explained over here is he started his business, that is written as commenced business with cash, that is $50,000. Now, if you can explain the effects this particular transaction has, I will appreciate it.
Yeah, to just ease out the accounting process and not to scare us much, I really want to make this very simple for our attendees because when I say I commenced my business with cash one fine day, it was a Friday considering, and I started my business with cash, or John started it on a Friday with $50,000. Now there are two things. John has got some cash which is to be invested into the business. Okay, but what would he invest it? Under what name? He would invest it under capital. That is what we saw some time back. Okay. Something that is brought in by the business owner into the businesses is capital. So I have two aspects here. I have two effects here. He's getting cash into the business under what name? He's getting it under the capital name. So cash is coming in. So the two accounts which are involved in it is cash and capital. Okay. So cash is a real account, capital is a personal account because it is recorded on John's name. So capital accounts are always recorded in the person's name or in the owner's name who brings in the capital into the business. So what will I debit? I will debit cash because cash is coming in into business and it is under whose name? Under John's name. So John cannot be the person who ultimately would be being credited, but capital would be credited. So cash account debit to capital account would be my entry. So I think Sayali, I'm clear. The audience,
Yes, yes.
please also let us know if we are
Please
going ahead.
comment in the comment box if you
Yes.
have any questions, if you are getting the examples, because these are the simplest examples we could come up with. Now, John would like he would like people to know about his bakery. He would like people to visit his bakery. So he thinks of spending $5,000 for advertisement. Now, can you explain the effect, Ankita?
Yes. So now let's say John expenses $5,000 on advertisement. So what does he do? He expenses. Okay. He has got an expenditure which is incurred directly, immediately. Okay. What are the two accounts involved here? He pays for advertisement. Okay. He goes to an ex-agency, asks them to advertise his business, his baking business. So what does he do? So here two accounts involved are advertisement and cash. Okay. So advertisement is a nominal account. Why nominal? Because it's an expense, and cash is the real account again. So I have debited expense. Okay. So I have debited towards advertisement. So my transaction would be advertisement account debit to cash because he paid to the agency in cash for advertising. That is why it's advertisement account debit to cash.
Okay, great. Now, I think John was really helped with the kind of advertisement he did. And there was some business which he could do. There were good orders which he received, and that is, I think, he received a good amount of cash, that is $10,000, and he thinks of depositing this cash into the bank.
Very well said, Sally, because I think all the cash that comes in into business should not be ethically, should not be expensed for unless and until you actually require it. So investing in business is always a very beneficial thing that can happen. So I think the third transaction says that he deposited cash for 10,000 into the bank. So again, there are two accounts involved here. What is coming in into the business? So cash is coming here. But where is he investing it? He's investing it into the bank. So I'll debit bank account, which is bank account debit to cash. Okay. So debit the receiver and credit what goes out. So it is according to the personal and real rule. Okay. Going ahead, Sally, fourth transaction.
Yeah. So John thinks of taking up his bakery, and he starts talking with one of his friends, Ruby, and he purchases some goods from Ruby, which is like almost $13,000.
Yeah, I get it because I think whenever we have this particular business being started up, I think John would want to, approach for getting a regular expense, okay, source where he consults Ruby for goods worth 13,000. So I think $13,000 he has made a purchase, okay, and who he has made a purchase from? Who has he purchased from? He has purchased from Ruby. So I have made a purchase, okay, for myself. So what do I debit? I debit my purchases account. But who did I get it from? I got it from Ruby. Okay, so Ruby is the giver. Okay, and debit all expenses. Now, why is there no cash, Siley, here? Our audience might be wondering because there is no chance. There is no chance of cash. There is no mention of cash as such. Okay, so that is why I have purchased, and purchase is important here. And who is the giver? Ruby is the giver. That is why purchases account debit to Ruby would be my entry.
Okay, great. Now, John's Bakery has really started gaining momentum, and he is getting a lot of orders from the neighborhoods. And he again sells some good amount of items for around $12,000, and he has collected a cash that amount of cash. So
Okay.
what does he do with
So
that
yeah,
cash?
so every time I think here when it comes to sale, basically it is also considered, or we can assume this as cash sale only and not a credit. That is why we have got cash account in place. So in return, whatever he sold in his bakery shop, he got 12,000 worth dollars of money, and whatever he got was in cash. So anything and everything he had put in a display in his bakery was sold out. Okay. So what did he do? He made a sale. Okay. So that is what happened. Okay. So what came in into my business? Cash came in into my business, and under what name it came? It came under the name of sales. So I sold something and cash came in. So my entry would be cash account debit to sales account.
Okay, great. Now, the last entry, it says that John has worked for some five-star hotel, and he has received a commission for around $4,500. So how would that reflect?
Yeah. So, and the last entry I think would be where John is getting good amount of commission because his business grew. He started commissioning well, and the two accounts that are involved in this particular transaction would be the cash account and commission account. So basically, he receives cash. Okay, and then under what name he receives it? He receives it under commission. So that's a commission received by him. That's an income by him. So cash account debit to commission would be the entry.
I think John the Baker example has really helped our attendees to exactly find out what kind of transaction, what kind of effect it has, and how does it reflect. So I think this example was really helpful, Ankita. Can we have a poll question?
Yes, yes, Ali. Please, we can have a poll question.
Okay. The poll question says, what is the primary purpose of a balance sheet? And the choices which you have is to show a company's financial position at a specific time, to track day-to-day transactions, or to forecast future expenses. So, what is the primary purpose of the balance sheet? Please click on the option which you think and believe is the correct option. We will soon discuss this question in detail. And we will be closing this poll in 10 seconds. So kindly participate as much as possible. What is the primary purpose of a balance sheet? Okay. So let us have the poll statistics. Let us see what people think that a balance sheet does.
Yes, it shows the company's financial position. Very correct, audience. Very, very appropriate, very spot on. Because I think balance sheet is a small mini record of, and also a larger record, I would say, of a point of company's assets and liabilities, to know where the assets and liabilities stand, to know where my business is at a particular point or at a particular date. Okay, great. So Sayali, going ahead. So now we'll be looking at the process of recording transaction. We'll start one by one. Okay. So the first thing that we record in a business is the journal. Okay. Now journal is the word which comes from French word a day, jour, which also means a day. So every day I record a transaction. Okay. So every day I have to record my transaction. So therefore journal means a daily record of transactions, and these are recorded chronologically date wise. Okay, just in case if you skip a date, we'll also look at what kind of errors occur. Okay, so these are recorded uh, chronologically basically, and it is as per the occurrence. Okay, so a journal book is a book of journal entry. Okay, and all the transactions are recorded in these books. Going ahead, Saili. Yeah, so here is a very good pro forma format of the Mr. John's journal. This is not the John that we were talking about some time back. This is just an example. This is just a sample. Okay, this is just to show you the journal entry that we have. So basically, as you can see, the first column is the date column where I record the date, which is the 1st Jan. Okay, the second is the description where I actually pass the journal entry. Okay, for a particular transaction. The third one would be the debit amount column. Okay, so basically, again, we'll go back. We'll go to the PR column. So the PR column is the post reference column. Now it doesn't make any sense, but it will make sense when it comes to ledger, because post reference column is used for referring to that particular ledger later on, and it's been numbered. Okay, so the number of ledger that it pertains to is put down there. So you put the number of the ledger in the PR column, which is the post reference for referring later on. And then we have the debit column. So basically the debit column records the uh, amount of the transaction conducted for, and the credit column. So we have two columns. So the first column is where on Jan 1, cash account to capital account, where it was started business with cash for 3 lakhs. Then on Jan 5, you have purchases to cash. So it also has got a small description under it, which says there was a purchase for 1,500 in cash. So this is how I think a journal looks like. Okay. And going ahead, Siley, we'll have a look at ledger. Okay, so the second most important thing after journal is posting the journal entries to ledger accounts. Now, ledger accounts are accounts which are specifically meant for specific purposes, which are maintained for a specific account. Those accounts that we saw sometime back in classification, the ones that are my purchases, my sales, my assets, my liabilities, my incomes, my expenses, all in all taken together. Okay, so it is also called a book of final entry, because ledger is the book of final entry, actually, not journal. Why? Because we can directly draw balances of a particular account from that ledger, specific ledger. Let's say on a specific date, I have to find out my cash balances at that date. And if I want to have a look at my cash balances for a particular date, what I do, I go to my cash ledger and I have a look at it. So I get to know where my cash balances are. Okay, so it is a summarized record. It is a small record. I record all my debits and credits there. It is assets, liabilities, expenses, and income. All in all are recorded under ledgers, and it is necessary for preparing trial balance. So now basically trial balance is a small format where I draw balances from different ledger accounts and post them to appropriate ledgers. Okay, or they are drawn from there and being posted to appropriate final accounts. Going ahead.
Ankita, let us discuss this with the help of example, shall we?
Yes, sure, we can, Siley.
Okay. So the example I have is a person called Simon. He starts his business on 1st of March 2023 with a cash balance of $10,000. And so given below are some list of transactions, we need to post it in the cash ledger account. So if you can
Okay.
explain each transaction.
Yes, yes. So audience, I think here we have a set of journal entries, okay, and we also have a ledger account as well, okay. So basically, we want these transactions to be recorded in the cash ledger. We want only cash ledger. We want to have a look only at the cash ledger, okay. So we'll look at the transactions one by one. So the first transaction is purchases to cash. So Sally, can you please flip to the second slide? Yeah. So basically, you'll have to keep flipping silently from this slide to that one. Okay. So can you just go back and forth, back to the journal? Okay. So the first transaction is on 6th of March 2023, where there was a purchase. Okay, so purchase account was debited. So he has purchased some goods for cash. So purchase account debit to cash, it's is goods purchased for cash. So for 2,500. So I have to have my purchases in place. I have to record purchases. So what do I do? Where is it recorded in the cash ledger? So Sally, please flip. Yeah. So my purchases were, so purchases account debit to cash. So on the credit side of cash account ledger, I have my buy purchases recorded on 6th of March. So buy purchases 2,500. So this is what my purchase was. So let's have a look at another transaction, which is cash account to Sam. Okay, so Sam has paid cash, okay, and that cash was worth 3,000. Okay, so where do I record this transaction? So I received some money from cash, it is to the debit. Okay, so I received and I have recorded on 3rd. Okay, so which is again 7th of March, and it's to Sam's account 3,000. Now going ahead, the third was on 10th of March, Macy's account debit to cash. So amount paid to Macy. So I have paid 2,000 worth amount to Macy. Okay, so I'll have a look at it. So I have paid, see again, it's by Macy. Okay, so it's 2,000 worth I paid to Macy. Okay, so cash went out of my business, and that's why I have recorded on credit side of the account, which is on 10th of March by Macy's account 2,000. Going back, cash account to sales. So okay, so I made a sale and I received some cash worth 7,000. Okay, so cash account has to be debited here with sales. Okay, so on 12th I have debited the account to sales worth 7,000. Okay, and the last transaction we'll have a look at rent account debit to cash. So I paid rent for 3,500. Okay, so for 3,500 I have made a payment for cash, and that payment was towards rent. Okay, so I recorded in the credit side by rent 3,500. Now this is a very critical case where I have to balance my account. Okay, so first what I do is I have a look at the debit amount total. Okay, so the debit side stands higher, it is worth 20. So 10 plus 3 plus 7. Okay, so where this stands on a higher side, I put the higher figure on both the sides, and then I balance the remaining side. So my credit side shows that it falls short of 12,000. That is my balancing figure for cash ledger, which I'll be pulling it forward to the next day, which is on the 1st April. So I pull this balance of 12,000 to the next day. So that is why it is to balance brought down 12,000. So I think I'm clear, Sayali.
Yes, very much. This example was really helpful.
Okay, now this is the final part where we will be looking at how we record the transactions, and finally the bank reconciliation, also the rectification of errors. Now coming to trial balance, I think it is drawn from different ledger accounts. All the balances are posted. So this is just a format where we see different balances. So I have cash and bank balance, I have receivables balance, I have the closing inventory balance, the fixed asset balance, and the accumulated depreciation balance. Then I also have some credit balances with me. I have sales, cost of sales, depreciation. These are just pulled from ledger from an XYZ source. I'm just trying to explain and show you how trial balance looks like. Okay, so it has got balances from ledger being posted. Going ahead.
Ankita, can you explain the depreciation expense?
Yeah, so basically this is an accumulated depreciation over a period of time. It is either provided or not provided, and if it is provided, it is provided later on. So it keeps on occurring. Okay, so it depends upon how I provide depreciation on my fixed assets.
Okay.
Yeah, Jonathan, I think we have a nice question here, Siley, because I am also getting some questions. So, Jonathan, you have been asking at what point should the trial balance be prepared? It should be at the end when my all leisure accounts are ready and I have got my leisure balances in place and I have to prepare my final accounts for the year. That normally happens on the 31st. It happens on the year end. When I finalize my final accounts, I prepare a trial balance. So it is at that particular date. And once I have my trial balance in place, I put all the resources from the trial balance into my balance sheet to get the particular position of the business at that particular date. So my balance sheet looks like this. On the asset side, I have current assets and fixed assets, whereas on liability side, I have current liabilities and long-term liabilities. Okay, so I have a list of current assets here, which are cash. Again, current assets are the one which are easily converted into cash, whereas fixed assets are the one which I hold for a longer period of time. And also, as you can see, the total assets and liabilities should always be same, have to be balanced. That is why it is called as balance sheet. And this balance sheet is pertaining to 31st December for 2013. It's from 2013, and all the balances have been set properly and have to be balanced. Okay, so this is what total assets and total liabilities are. Okay, going ahead, Sayali. Okay, now next let's see what are the different subsidiary books my company maintains. Okay, my day books, my everyday books. So these are day books, something which only give me a short and a small brief on what I want. So my purchases book gives me a short brief on all the purchases that I'm taking off, that I'm taking care of, or that happen in a business. Sales book helps sales. Okay, if I want a small and quick easy view of how my sales look like, I refer to sales book. The purchases return, basically at times it happens when I purchase something I don't need it, I have to return it. So that is my purchase return, I return it. And sales return is where somebody returns me if I sell something. So that is my sales return book. So these are my day books. These are maintained on a regular basis. My bill books, okay, the books that I have to pay bills for or I receive bills from are the bills receivable, something that I'm going to receive in terms of the bill payment made by people. Whereas where I have to pay bills, I have to make payments to people is my bills payable book. Then I have the cash book. Cash book is again of two types. The cash book where I get record of all my cash and bank transactions. There is no bank book as such. Everything that I have in a business is always pertaining to cash. There is no bank book as such. There is cash and bank transactions recorded in your cash book. And then I have a petty cash book. Petty cash book is recorded for very minute transactions, small transactions, which are conducted on a very small basis, have got a smaller amounts. Okay, so this is cash and petty cash book. And lastly, I have journal proper where I record my journal. Okay, we'll have a look at a small example from cash book as well, Sayali, because I think recording cash transactions is again important. So we'll see how cash book looks like. So cash book is a special type of book that is only concerned with recording of cash transactions. Okay, and features of cash book are very peculiar. It acts as both journal and ledger because I have a small brief on what transactions are happening. Can be used as an alternate to cash account. So I don't have to maintain it as such. I have immediate access to cash that comes in and goes out of my business. It follows the dual entry. Yes, indeed, it follows the dual entry when cash comes in and cash goes out. The debit side should be, identical to the credit. Yes, it is balanced later on because whatever is the balance may be a debit or a credit, it's balanced later on. And cash book should always have a debit balance. So every time you need to have excess cash because you have to expense in cash, you have to have liquidity in your business. So it should have a debit balance. Going ahead.
Nikita, I have a number of transactions here. Can you help me post it in the cash book?
Yes, sure, we can do that, Sayali.
Yeah. Okay. So here, Mr. Y initially deposits the fund from his personal saving amounting to $50,000.
Yeah.
Out of this, shall we go back and forth again?
Yes, we can go back and forth.
Okay. Okay.
So yeah, we have got the start where we have 50,000 amounting to capital. Okay. So on 1st April, I have got capital worth 50,000, which is recorded to my debit. I'll be expensing it. I'll be having it been expensed later on. Okay, it's under my capital. Okay, it's recorded under the capital. So I have it on 1st April on my debit side to capital account $50,000. Going ahead.
The second transaction shows. I'm sorry.
Sally, why don't you just read out the transaction? We'll just
Okay.
explain it in the
Okay. So out of this capital, he invests around $20,000, which he again deposits in the bank account. He also
Yeah.
purchases some stationery for around $100.
Oh,
And
Sally,
there
can
are
you
some
go to
good.
the ledger and you read
Yeah.
out the transaction so that we'll be looking at how they are
Okay.
posted.
So
Yeah.
on the
So what
left
was
hand
the
side, I can see some sale of $11,000.
Yeah. So there is sale of $11,000 on 7th. Okay. So he made a sale and the sale was for 11,000. So it's been recorded as sale on the debit side of cash book. Whereas on the right side, we have transactions pertaining to credit. Okay. So on the 1st April, he has got some bank, transaction occurring. So which is recorded under 20. Then he has paid for stationery for $100. Then there was a purchase on 4th, which is for 10,000. Then there were office expenses being made for 700, advertisement for 500, and then again some investment in capital or capital was drawn under drawings. So 1,000. Then by salary, okay, which is 10,000, and then there is the balancing figure. So as I already told you, we have to take the greater figure on both the sides, okay, and there is 50,000, okay, plus 11,000 makes a total of 61 on both sides. I post it as it is, and the balance which is there on 30th April would be 18,700. So that is how it is 18,700 being balanced at that date.
So this balance will be carried forward.
Yes, this balance will be carried forward the next year, okay, and it will be also recorded, okay. Why it will be recorded the next year? Because these cash balances, again, there will be some addition the next month, the next year, whenever it happens, and then immediately this starts accumulating, and the concerned person who's maintaining the cash book starts paying out of this, okay. So this is the cash book. This is a single columnar cash book, audience. Let me tell you, we have tried to cover a single columnar cash book. We also have a dual columnar cash book, which has got bank and cash, okay, together, and we record all the bank and cash transactions in it. Okay, now going ahead, we'll have a look at the bank reconciliation statement. Now, when I say bank, I mean I have to balance my cash balances in business and bank balances, because those are very important assets of my business. Okay, so Sally, I think when it comes to bank transaction, there is something called as passbook. Okay, so passbook, I'm sure all of our audience might be having their own passbook, okay, and might be having a bank record of their transactions, which is conducted on a daily basis or on monthly basis or whenever they have their transactions, okay. So when I have to compare my balances of business and bank, because bank is a place from where there will be a lot of payments coming in and out of business, so that is what I am going to do. I'm going to reconcile my accounts, if not concile, if not been in balance, when it comes to bank reconciliation. So bank reconciliation is comparing the balance of accounting records with the bank account balance. And the second feature of it is it confirms the payments if they have been processed, if there is lag, if there was a delay in payments, if there is some issue. Okay, so there are issues which keep happening when it comes to bank transactions. At times you have a check which is to be cleared, doesn't get cleared. Okay, it takes time. Okay, it takes days for it. At times it gets bounced. Okay, there is loss in transit. Okay, so at times this happens. Okay, so when the confirmation of payment happens, okay, and it is processed, I get my cash. Okay, so this is how the bank reconciliation occurs. So what is the 6-step process for bank reconciliation? I have to compare my bank book balances. I have to look for the omissions that happened, the errors that happened, something that I missed out, okay, a recording or something that was missed. Fine. Then I have the bank account statement. Then I have to adjust my bank balances and cash balances. And once I record, it's been reconciled at the end.
Ankita, if we are putting our expenses and income as per the respective column, I don't understand why do we need to reconcile the accounts again?
Yeah, so basically, Sally, in a business, because there are huge volumes of transaction happening, there is also lag, there is also a delay on the part of bank when it comes to bank transactions, and there is a chance that there are high chances that I miss out on recording a transaction. So that is how we'll have a look at what kind of transactions I miss out or what can happen, okay, in the next slide. Okay, so these are the common errors in reconciliation. There are outstanding checks. Let's suppose you have deposited the check today and it did not get cleared. It takes about 10 days for the bank. There was a bank holiday in between. The check did not get cleared, but then it went out of your account, right? It has already been, you are thinking that it's being paid and it will soon be cleared, but it did not. So again, that is one. These are the common errors that normally happen, and these need reconciliation with respect to cash book and passbook. Now, second, deposit in transit. At times it's been deposited but not recorded. Okay, so at times it's been lost in transit. Okay, so it's deposited but not recorded. Bank service charges. At times the bank cuts some service charges, but then they are recorded in the passbook. You don't see them in the cash book being recorded. There are check printing charges being cut out by bank, but then you don't see them in the cash book as well. Now, errors in the books. At times I debited a wrong account. At times I credited a wrong account. It is there in my account, but then by mistake it got debited or credited in the bank. Okay. So errors in my books, again, errors in my cash book will again differ from the bank. Errors by bank itself. There might be an error of, check not being posted on the right time, being debited to some other account. Okay. So that debited or credited. So there might be errors from the bank as well. Electronic charges on the bank statement are not yet recorded in the books. There are electronic charges at times being missed out, okay, and electronic deposits. So basically, all these transactions tend to occur in case of the cash and passbook recording, and they have to be settled well. Going ahead.
Yeah, these errors are actually very minor. However, they play very important role. So let us
And then
understand this.
basically, Sally, what happens is when these errors occur, there is a discrepancy in the cash book. There is a chance of wrong balances that come up, and then your balance sheet does not tally at the end. So this is very important, okay? So because there are errors being occurring, cash and bank errors, if not resolved, will show a discrepancy figure in your final accounts, will show a discrepancy figure in your ledger, will show a discrepancy figure in the balance sheet. So this is how the common errors occur.
Let us understand this even better with the help of an example.
Yeah. So
So in this
basically,
example, go
yeah,
ahead.
yeah, Sai, please go ahead.
So in this example, Emily, who's a financial account, she's working for a well-known company. And on 1st of June, she notices that there's a discrepancy of barely $50. And this discrepancy is between the company's cash book and the bank's passbook.
Thanks, boss.
Now let us help Emily that where exactly this discrepancy lies, and let us go through each and every transaction.
Transaction. So I think by looking at the bank records and cash book, I think our audience must have got a very good idea. What's the audience? You can put it in the comments. I hope you have, got the answer as well. Please have a very good look at it. I'll give you a minute where I think you must be able to track where Emily has gone wrong and has not recorded something. So please let us know in the chat box if
So
you
on the
can.
right hand side, if the audience can see, there are this is the record as per the passbook, and there are different entries with the opening balance. There are more than couple of checks which have been deposited, and the amount
Yes,
is
yes,
already given. And on the left hand side, this record is as per the cash book. So again, the
yes,
check and the check numbers and the amount has been clearly given. But again, as you can see, there's a discrepancy of only $50. On the right hand side, it is $10,300, whereas on the left hand side, it is $10,250. So if you can let us know, have you spotted the discrepancy? If yes,
yes,
where?
yes. Yes, I think we are getting very good responses. I think, yeah. Yes, Annie, you're correct. Yes, Emmanuel, you're correct. Okay, so yeah. So we'll be answering. Okay, we'll have a look at the cash book, Sayali. Now, as you can see, Sayali, there is an opening balance of 10, okay, and there was a check paid, okay, for 200, which was check number 234, check number 236 amounting to 50, check number 240 amounting to 500, and the client had deposited 1,000, so my balance was 10 to 50. Okay, but then there we'll see how my passbook differed here. Okay, so we'll start with the passbook balance being 10. Okay, my 200 worth check, which was 234, is being recorded, which is correct. A client deposit of 1,000, again, the one on the left and the right matches. And then there was another check, 236 worth 50. Okay. And then 240, 500. So what I left out was 50 and 100. I think this 50 and 100 has not got any record anywhere. So my passbook has got the record. Okay. My passbook has Sayali on 22nd. It has bank service charges worth 50 and interest earned. Okay. So bank service charges was my debit. It was my expense, which was cut out. Okay. But I did not post it to my cash book in my business. Okay. So that is missing in my business. I don't see an entry worth 50. Okay. I see worth 236. Okay. Check. But the next was bank service charge. It got missed out. Fine. And then the next was the interest earned for 100. Okay. So the interest which was earned for 100 is also there in the passbook, but not recorded in the cash book. So I have got calculation here. Okay. So I've got 10 to 50 where I add 100 because I received 100 worth interest. Okay. And then I subtract 50. So now my balance comes down to 10,300. Okay. So on both the sides, the balance is 10,300. So where I couldn't record these two transactions, I corrected it. I reconciled it by recording the transactions in the cash book and brought my cash book and bank balance to be 10,300, 10,300. So I think, Sally, it's clear now.
Yeah, this is amazing. But Ankita, in this case, I need not be an accountant like Emily. I can do it on my personal basis as well, because there are many number of transactions.
Sally, when it involves huge amounts of transactions, I think you need to have a very good understanding of what bank transactions are and how they look like. Okay, so that is how that it will be.
Okay, okay.
Okay.
Ankita, before we go ahead, can we have a poll?
Yes, Sally. Yes, we can have a poll.
Let us have a poll. So I think we have already covered this. What does the acronym GAP, that is GAAP, stand for? This is in the account area of our bookkeeping. What does the acronym GAP stand for? Is it the generally accepted accounting procedures? It is the generally authorized accounting principles? Or is it generally accepted accounting principles? Very close, yet different. So please select your option very, very carefully. We have covered these accounting standards which are practiced in the United States and the rest of the countries. So if you remember, we covered this at the beginning of our webinar. What does the acronym GAP stand for? Last 10 seconds for the poll. I would request each and everyone to participate as much as possible. We will be closing down the poll soon, and we will be discussing the answer as well. Okay, so let us close the poll and let us have the poll statistics.
Yeah, Sayali, I think 71% goes to generally accepted accounting principles. Yeah, we saw that some time back. Okay. And this is what generally accepted accounting principles. This is the definition. That is what we saw some time back. These are accepted in US itself. So I think that is the answer. Generally accepted accounting principles.
I think people are still getting confused because some did click on the first and the second option because the options were very similar. So that is where the trick was. Thank you so much for participating in the poll. Let us go ahead. Ankita, over to you.
Yes. So I think we are in the last segment, Sayali. Once we are done with this, we are going to have questions being shot from the participants at about at 5:15 or 5:10. Okay, now going ahead, we are the last segment where we are looking at the rectification of errors. So rectification of errors is very important. What kind of errors occurs in a business? Okay, so a core principle of accounting is that every debit should have an equal credit, but at times it happens that every debit may not have an equal credit, may have an amount error, may have the wrong account, may have the wrong time, may have the wrong entry. And at times there is a very critical situation where at times there are something called as compensating errors also, and still you see your balance sheet getting balanced. Now let me make you very aware with respect to rectification of errors, because they are very critical to a business. If this basic principle is violated in any manner at any time or at any stage during the accounting period, an error occurs. Okay, so what are the reasons for error? So the reasons for error are when you are having inappropriate accounting knowledge. There is lack of accounting knowledge. There is wrong data collection. You have collected wrong data from a wrong source. You haven't recorded your debit and credit correct. Your entry is inappropriate, and you're not having enough information on a transaction. There are chances of a wrong entry happening. Then the third is wrong recording. Now, wrong recording is basically I record a purchase as a sale as a purchase, a expense as an income, or as income as an expense. So anything can happen. You have to be very careful, and you need to know bookkeeping in and out. And lastly, there is incorrect arithmetical calculations. If you are debiting a particular account with 5, but you had to debit it with 10, so again there will be an error of 5,000. Okay, so you will be either falling short of 5,000 or 5,000 will be more. So basically there are 4 basic types of errors. So errors of principle. Now error of principle is where I don't know accounting at all. When I don't know accounting at all and I'm unaware of how I'm supposed to record a transaction, I happen to conduct an error of principle. Okay, I don't know which account to debit, which to credit. I have conducted an error of principle. Now second, if there is an error of omission. Now omission is somewhere I uh, automatically by any chance forgot to record any transaction. I omitted it entirely. I omitted it completely. I couldn't record it. That is why there might be a discrepancy occurring. There might be an error occurring. Third is the error of commission. Okay, if I debit wrong account with the wrong amount, so wrong account debiting. Okay, error of commission, it's been committed. Okay, it's wrong, it has to be corrected, it will be corrected. Okay, and compensating errors, that is what I told you at the start. You have to be very careful. Even if you conduct and happen to have an error, at times it happens that these errors also show an appropriate figure and there is a balancing happening there. Okay, you will have to you will have to dig deep into your journal, your ledger, and refer to your trial balances to pull out this compensating error, because it compensates if a transaction is presented or is recorded wrongly. So there are 4 types of errors which are very broadly classified, and these happen in the accounting or bookkeeping process. Going ahead.
So I think let us have an example on rectification of errors.
Yes, we will have an example. Yeah, so basically these are the types of errors. Okay, so compensating errors, errors of commission. Okay, so compensating errors, if the effect of errors committed cancel out, the error will be called as compensating. Error of commission, if the amount is posted wrongly. Okay, errors of omission, if a transaction is completely or partially omitted. And an error of principle is when a transaction is recorded in contravention of the accounting principles. Okay, I think Saili, I have covered this in the last slide itself. We'll go ahead.
Yeah. Go ahead with the example.
Yeah, so we have a final example where we have, for example, a company's sales book is undercast by 1,000. Okay, and this can be corrected by crediting the sales account directly with 1,000. No rectifying journal entries required. Now, undercast is something where I'm falling short of 1,000, which means I did not record it at all. Okay, if a sales book is undercast by $1,000, which means I left out an error unrecorded worth 1,000. Okay, so worth $1,000, there was something, a sale which had to be recorded, could not be recorded, and there was, this is again an error, I have to record it. So which means I will have to record this transaction and compensate the error. This does not require an entry because it is not recorded, so it will have to be recorded. Now going ahead, we'll have a look at an entry which went wrong, and we look at the rectifying entry. Okay, suppose the sale of old furniture for 5,000 is credited to sales account. Okay, So there is sale of furniture, okay. In return, what am I getting is there is actual sales happening, okay. And then there is old furniture, okay. So suppose there is sale of old furniture and it is recorded as sales, okay. So that's not sales, that is sale of furniture. So sales is something which happens on a daily basis. I sell out something from my business, I sell my goods, okay. But furniture is again my asset, okay. So I sold it. So my actual entry, okay, so my correct entry would be the sale of furniture, okay. So cash to furniture, fine. But my okay, it wrongly got credited to sales. Now what will be my rectifying entry? How would I rectify it? Okay, I will rectify it first by crediting what I want, okay. So my furniture has to be credited first, and what is wrongly credited? Sales is wrongly credited. So just to nullify the effect of sales, okay, in credit, I'll debit it and return. So my rectifying entry would be sales account debit to furniture. So this is how there are chances where there is errors being happening, okay. And when these errors happen, we have to rectify the error. So I think, Sayali, we have almost have had our segment where we were about to give our you know feedback also on how it went, okay. So we also want a segment where we have a feedback from the learners as well. So you can put that in the chat box. And I think we are up for Q&A sessions, highly,
Yes,
for the next
absolutely.
10 to 15
Ankita,
minutes.
thank you so much. Especially, I mean, a person like me who is from a non-finance background, I think there were a lot of terminologies which I always struggled with. And this session has definitely helped me clear out all those doubts. And I can definitely use all the information in my future. And I'm sure this has happened with many of our attendees as well. So let us test. Ankit, I'll ask you to rest for a while because we have some exciting questions for our learners. Let us see how carefully they have attended the webinar, and let us go one question at a time. You can answer these questions to these questions and put a comment in the comment box. So let us have the first question. A dash amount will appear on the left side of the trading account. So is it debit or credit? If you remember, Ankita had shown us the slide where she explained the debit entries and the credit entries. So kindly put your comment in the comment box and let us know what is the right answer, if it is debit or credit. Ankita, you may have to explain this to our attendees.
Yes, yes. I think, Sally, we are also getting answers from them. Okay, so it's debit. Okay, that is what the answer is. Fine. So yeah, a debit amount will appear on the left side of the T account because the ledger is a T account ledger, and all the debit entries are to the left, whereas all the credit entries are on to the right.
Okay, great. So let us go to the second question. When a check is written, a cash account should be. So let me tell you that a check is spelled differently in different countries. So this is CHECK, whereas in some countries it is spelled as CHEQUE. Am I right, Ankita?
Yes, yes, it's correct,
Okay,
Sally.
so yeah, so if this is written, a cash account should be. So if I'm writing a check to someone I know, will my account be debited or will it be credited? If it is credited, I'll be very happy to write many checks, as many checks as possible. So kindly write the correct answer in, please put it in the comment box.
So
When a
maximum
check is
answers are
written.
credited. So it's credited, Sally, because maximum answers are credited here, and
Okay.
because it's been, yeah, and it's a check. It pertains to bank account as well. So we have involvement of cash and bank transaction as well. So it's credited.
Correct. Let us go to the third question, wherein revenue accounts will normally have what kind of balances? Will it have debit balances or credit balances? So please put in the right answers in the comment box. Revenue accounts will normally have what kind of balance? If it's debit balance or a credit balance. Ankita, what would you comment on this question?
Yeah, so Sally, maximum answers are in credit favor. Yeah, and revenue accounts are basically when I receive something, okay, I receive incomes, I receive credit, okay, and I receive credit, I mean, I receive money in return, okay, so that is what is my revenue, okay, so that is why it's credit here.
Correct. Thank you so much. Let us go to the next question. In large corporations should report revenues on their income statement when the cash is received or revenues are earned. Now, audience, this is very close. Cash is received or revenues are earned. What should the large corporations do? Should they write it on the income statements? Kindly give your correct answer. Large corporations should report revenues on their income statements when cash is received or the revenues are earned.
So basically, I think, Sayali, this is also where revenues are earned. Okay, so this is a revenue earning which happens. So cash did not necessarily be there all of the time. So we have income statements which we record for revenues. Okay, and I think we should take the last question, Sayali, because it's almost 5:20. We have 10 minutes for Q&A.
Yes. Absolutely. The last question goes, a supplier of goods or services is known as, it is a very simple question, and I'm sure that you will instantly answer this question if he is called as a debtor or a vendor. A person who supplies goods or services, who is he called? Is he called a vendor or a debtor?
Yeah, for sure, because he's
And the correct
supplying
answer?
me. Yeah, it's my vendor. It's the vendor who I buy things from. Okay, he keeps me supplying with goods. So I think that is vendor.
Okay. Thank you so much, Ankita. Audience, I will request if you have any questions, please frame it and put it in the chat box. We will be answering all of your questions. And before the question and answer round, let us quickly go through a very small information session about Uni Athena. Meanwhile, if you have any questions regarding the webinar, any conceptual information about the webinar, regarding the bookkeeping essentials throughout the webinar, kindly frame your question and put it in the comment box, and we will be soon addressing the questions. Okay, I thank all of you to attend this webinar today, and I would like to thank from on the behalf of Uni Athena. And this is a great pleasure to have all of you on the platform. And I'm very proud to tell you that Uni Athena is a platform which is very much affordable, flexible, and accessible. We have a number of courses available to a lot of people from across the world. And these courses are available in a lot of areas like business management, health administration, and finance, supply chain management. So this is a very good platform for people who are looking to upskill themselves. And Uni Athena was established in the year 2019, and this is an edtech company, and we are headquartered in the United Kingdom. And we offer online academic and free learning short courses, which I told you that they are very affordable and flexible in manner. They are self-paced, and you can very well prioritize your learning as well as your professional commitments, personal commitments, and you can always complete these courses with Uni Athena. As you can see here, we have a proud partnership with more than 10 universities across the globe. And we have more than 225,000 present in 212 plus countries. And we offer more than 400 courses throughout. These are our partners, and as I said, these are across the globe, from Spain, from Italy, then United Kingdom, Arizona, United States. We also have Cambridge International Qualifications as our partner, and we are really proud to have partnership with these bodies. We offer a different kind of academic programs. We offer masters. We also offer microcredits. We have a very popular program, which is the MBA program, which a lot of people are enrolling, and they are giving us the testimonials that this is very, very helpful to them in their personal and professional lives, and it has gained a different kind of expertise within them, and they are very much enrolling for the MBA program. We also run a doctorate program, and we have short courses which are for free. These are some basics, essentials. We also offer some diploma, executive diploma, and MBA essentials. Now, you would ask me that why Uni Athena? So we have different features. Why Uni Athena? The first feature is flexible payment. So what you can do is you can take one module at a time, and you can pay as you progress in the course. So if I have one module, I can pay for it. If I'm done with the module, I pay for the next, and so on. The next feature is it is 100% online. We have different types of material, educational content, which has video tutorials, reading materials. You can always get information from all of these resources, and you can do it from any corner of the world because it is 100% online. Then, as I said, it is a self-paced program. If I am a professional, I can always balance out these program or courses during my weekend when I get time, or maybe during the evening time, and I can do it as per my own pace. We also have accredited university partners, which I showed you throughout the globe, and we also have personal tutor connect. So when you enroll for a program with us, you are immediately given a personal tutor who connects with you, and he or she tries to help you throughout the program, and they have a personal connect with you, and there is a rapport which gets built up, and you have their mentoring throughout the program. Now, experience courses delivery designed for you. As I said, it is 100% online. We have bite-sized delivery, and we also have lesson video tutorials, which you can always listen or watch as per your own convenience. You can pause them. You can always listen to them while you're working. So these lesson tutorials are very, very helpful. So this is how your lesson video tutorial look like. You will always have the pointers, and the expert is talking about that particular concept. We also have these concepts explained in detail, which are called essential readings. And the same concept is being elaborated, and notes are provided, which you can always go through and save it for your lifetime. This is how the essential readings look like. That particular concept is again explained in detail and elaborated. Now, additional readings, you can always access some additional readings which are closely related to that lesson or concept, and which will give you in-depth knowledge of that lesson. This is how the additional readings will look like. It can also take you to some other source. It could be a book, it could be a business journal, it could be an article. So this is something which will be additional to the essential readings or the video lecture. And these are the different levels which you will go through once you enroll for the program. So this is a basic how the dashboard will look like. Now you can also check out all the offerings which we have on www.uniathena.com. I would request all of you to please visit our website and enroll for the course which really excites you, which you think that it will help you in your career as well as professional, personal front. And there are a number of courses, as I told you. Kindly go through all the courses and register as soon as possible, and we will be more than happy to help you. These are our different offices and locations. If you are interested in admissions, kindly note down the email ID, admissions@uniathena.com. And we have a person who will be helping you. Her name is Fatima at uniathena.com. She will answer to each and every query of yours. And if you have nothing to write down, kindly take a screenshot, which will be helpful for you. And please let us know if you are interested in any of our programs. Thank you so much for attending this webinar and being a part of this insightful journey. We are open for the questions now. Ankita, shall we start with the Q&A round?
Yes, Ali, I think we will be having very few questions to answer as we are out of time as well. And I
Okay.
think we had covered most of the part. So basically, I've shortlisted some questions for you, which I find
Great.
interesting. I've sent them out to you, so you can please go ahead with the same.
Okay. Can you start with the first question?
Yes.
Okay. So we have different questions from our participants, and let us see what questions you guys have. I'm sure that a lot of people are okay. So first question comes out as, do we need to cross check our bank statements they send us at regular intervals? So yes, people, I mean, banks do send us these statements on a regular basis. So the first question is, do we need to cross check? That is what the question is, Ankita.
Yes, yes. So, Sailia, I think this is a very good question because it is a very thoughtful question as well. Because bank keeps sending us the monthly statement, which is what we know. Okay, so we have a bank monthly statements which have to be all in all always checked on a regular basis because we are very much having a huge amount of transactions happening throughout the month. And when we have to have a quick reference of what we have transacted in a month, I think that is very helpful for understanding what we are at what place we are. Okay, so in terms of our transaction, so I think this is very important. We have to check it.
Great. Okay, the second question is, how companies turn reputation into money? That is an
This
interesting question.
Yeah, this is, I think, a very interesting question because companies turn a reputation into money in a lot of ways, and reputation in itself is an asset, as we saw some time back. So once you build a reputation, it's been built for years and years long. So again, I will again go back to the example that I gave because we go back to the same brands again and again. We have that trust, we have the loyalty, the faith in them. I think that makes us more attracted to that particular brand. Okay, so I think that is easily converted into money. That is a plus point for all the businesses. And that is something which cannot be, there is no other asset as such which can give you this other than the one, which is the reputation or the goodwill of a business.
The next question, Ankita, it comes is bank reconciliation normally done by auditors or anyone in the organization can do it?
So basically, bank reconciliation is the business owner's job itself. There are accountants for your business who take care of your daily transactions. Okay, auditors all in all take care of if the transactions are recorded correct or not. Okay, so your main accountant, the person who maintains the accounting records in your business, is the one who's always responsible for that bank reconciliation. And if there are still errors being occurring or there is a discrepancy, anything, it is caught by the auditors because there is I would use the word caught because they find out that particular error at that particular time. And once they find out the error, they get to know where the discrepancy lies. So I think all in all, both the checks on both the levels are very important.
Okay, great. Thank you. The next question is, I think you've already explained this, but possibly the person wants to know it again. What is subsidiary book?
Yeah, so basically, subsidiary books are the books which are maintained other than the normal books of accounts, which I maintain my regular journal and ledger books or cash books. All the subsidiary books which help in subsidiary activities of the business. Okay, so those are subsidiary to business. They are secondary in nature. Okay, and they can be referred to for a quick figure on a particular account at any point of time.
Okay, great. Unfortunately, we have to take this last question because we are running out of time. The last question is it the same to the statement that ledger is called the book of original entry?
Yes, yes. Actually, the book of original entry in itself is ledger and not journal, even if the transaction is first recorded in the journal, because ledger is the first hand entry where we record it in a particular account, and that account is important. That is why it's the book of the original entry. So I think, Sayali, we have answered almost all the questions, and I would like to thank all our audience for attending and patiently listening to us. And I wish you all a very Merry Christmas and a prosperous New Year and happy holidays.
Thank you so much, everyone. And I really